Our next guest manages various funds at Oakmark, including the Oakmark Global Fund. David Herro, Harris Associates Partner CIO, International Equities and Portfolio Manager, joins us now. You know, it's been rough for international equities. The U.S. still continues to be the center of the action. Is there anything you're seeing, David, that looks like that will change?
Well, this has certainly been the case. And even if you look over the last 10 years, the EFA index, World X the U.S., barely up 4 or 5%. S&P 500 up 13 or 14% per year over 10 years. But we're getting so lopsided now. The valuation differential is getting so large that I think when you're looking for pockets of opportunity where to invest, you certainly have to consider overseas stocks because the fundamentals remain okay. They're not robust, they're not booming, but we're growing, good mid-single digits, and yet we have price to earnings ratios of our portfolios, for instance, of just 10 times. And this is 10 times on top of a projected 10% earnings growth. So these kinds of value characteristics make it almost irresistible to start dipping your toes or growing your international exposure.
And except while the fundamentals, I mean, not to cut you off, but a lot of people would argue with the fundamental point, the lack of growth across these economies, the fact that they still have a little bit firmer inflation numbers, the fact that they don't have Magnificent Seven or AI companies or anything exciting like that. I mean, that's what they point to as why they're cheap, and maybe they should stay that way.
Yeah, but this is really not an adequate criticism because companies that are based in Europe, their growth rates aren't dependent upon where their home is. They're dependent on where they do business. And many of these are global businesses. I mean, think of some of the global industries based in Europe that there's no U.S. competition for, luxury goods in particular. Then you could also look at other industries such as pharmaceutical, where you have a very strong pharma sector in Europe. So one has to separate company growth and company fundamentals from what's happening in the various macro economies where they're located. And this misnomer, this imperfection, allows a bona fide long-term investor an opportunity to make money. And then secondly, not all of Europe is Germany. Yep, go ahead.
No, well, all right, actually, my question was about Germany. I mean, the rising cost of energy there has upended the margin picture for any number of industrial companies in that country. Are there opportunities there? I know they're trading at incredibly low multiples, or is it actually concerning?
Yeah, I mean, first of all, the German economy is concerning, and thankfully there's going to be an election in the next month, and hopefully we have better free market policies get instituted, because Germany is once again the sick man of Europe. Now, there are other places in Europe that are doing very well, Spain, Italy, Portugal, Scandinavia, etc. But Germany, the continent's biggest economy, sadly is on its back. And to the extent at which German companies have to pay high energy prices, we do have to factor this in to how we value the businesses. But luckily, again, think of a company like Siemens. It's a German company, but it does business all over the world. It does, process software, industrial process software, factory automation. It does business all over the world. And you look at these companies, even the car companies, incidentally. Take Mercedes and BMW. Only 1/3 of their business comes from Europe in general, whereas the other third comes from Asia and the U.S. So this is, again, where there's opportunity. Investors get scared off by German policy in particular. And by the way, the UK, sadly, isn't learning from Germany's mistakes. This is bad for the UK macroeconomy, but that doesn't necessarily mean that the UK companies are all going to suffer, especially since they do business everywhere.
Yeah.